There's a strange moment that sometimes appears in financial markets. Stocks are rising, headlines are optimistic, retirement accounts look healthy. And yet, quietly, in the background, something else is outperforming almost everything. Gold. Not a flashy tech company, not a breakthrough startup, just a heavy yellow metal that has existed for thousands of years. And lately, it's been beating stocks. That sounds almost backward. For decades, the standard retirement advice has been simple. Buy stocks, hold them for the long term, and let compound growth do the work. Equities are supposed to be the engine of wealth creation. Gold, on the other hand, has often been dismissed as something conservative investors buy when they're nervous, insurance, not growth. But recently, the numbers have started to challenge that narrative. In several recent periods of market turbulence, gold hasn't just protected portfolios, it has outperformed the stock market entirely, which raises an uncomfortable question. If gold can sometimes outperform stocks, why don't more retirement accounts include it? And perhaps more importantly, how would someone actually add gold to a retirement portfolio in the first place? Because the answer turns out to be far more complicated than most people expect. Let's start with the basic story most people are told about retirement investing. It usually goes something like this. When you're young, you buy stocks.
For over a decade, gold quietly delivered stronger returns than equities. It happened again in shorter bursts during later crises. In moments of panic, banking instability, inflation scares, geopolitical conflict, investors often move money out of financial assets and into something that feels more permanent. Gold becomes a kind of psychological anchor, a hedge against uncertainty. But here's where the story gets interesting. Gold's performance isn't really about gold itself. It's about trust. More specifically, trust in financial systems. When investors feel confident about economic growth, they prefer stocks. But when confidence cracks, when inflation rises, currencies weaken, or governments accumulate massive debt, gold suddenly becomes more attractive. Not because it grows, but because it doesn't depend on anyone else's promise. Stocks rely on corporate profits. Bonds rely on borrowers repaying debt. Currencies rely on governments managing monetary policy. Gold relies on nothing. No balance sheet, no central bank, no earnings report. Just scarcity.
Lots of them. Companies grow. Profits rise. Over decades, the stock market climbs. Meanwhile, bonds provide stability as you get closer to retirement. This simple model has powered retirement systems across the world. In the United States, retirement accounts like 401ks and IRAs have poured trillions of dollars into the stock market. The logic seems unbreakable. Stocks represent ownership in businesses. Businesses generate profits. Profits drive long-term returns. Gold doesn't do any of that. It doesn't pay dividends. It doesn't generate cash flow. It just sits there. Which is exactly why economists often describe gold as a non-productive asset. And yet, that same non-productive asset has outperformed the stock market in certain stretches of time. Sometimes dramatically. Consider the early 2000s. Between 2000 and 2011, gold rose roughly six-fold. During that same period, the stock market experienced two major crashes, the dot-com collapse and the global financial crisis.
And that strange independence is exactly why gold behaves differently than most assets inside a portfolio, which is where retirement planning enters the picture. Because retirement investing isn't just about chasing the highest possible return. It's about managing risk across decades. Imagine someone building a retirement portfolio over 40 years. During that time, markets will experience recessions, bubbles, policy changes, wars, inflation shocks, and technological revolutions. No single asset class performs best in every environment. Stocks dominate during economic expansion. Bonds often perform well when interest rates fall. Real estate benefits from certain inflationary cycles. Gold tends to shine when financial stress spreads through the system. Which means gold's role isn't necessarily to beat stocks every year. Its role is diversification, a portfolio stabilizer, the asset that behaves differently when everything else moves together. And over long periods, that difference can quietly improve the overall resilience of a retirement account. But if that's true, why don't more retirement portfolios include gold? The answer comes down to structure. Most retirement accounts simply aren't designed to hold physical assets. Take a typical employer retirement plan.
Inside a standard 401k, investors usually choose from a menu of mutual funds or ETFs. These funds are primarily built around stocks and bonds. Gold bars don't fit neatly inside that system. You can't exactly store a stack of bullion inside a retirement account custodian's vault without special arrangements, which is why most investors who want exposure to gold turn to something else: gold ETFs. Exchange-traded funds that track the price of gold without requiring investors to physically hold the metal. The idea is straightforward. The fund buys and stores large quantities of gold in professional vaults. Investors buy shares of the fund, and those shares move with the price of gold. In effect, it allows a retirement account to gain exposure to gold just like any other stock. Simple, liquid, easy to trade. Many retirement plans allow these funds. But ETFs aren't the only option. Some investors go further. They open what's known as a self-directed retirement account. This type of account allows a wider range of assets beyond traditional stocks and bonds. With the right custodian, investors can hold physical gold, silver, and other precious metals directly inside the retirement structure. But this path comes with additional complexity. Regulations are strict. The gold must meet specific purity standards. It must be stored in approved vaults. And the account holder cannot personally hold the metal. Doing so would violate tax rules. In other words, even when investors own gold inside a retirement account, it still sits inside a professional storage facility somewhere, often thousands of miles away. Which highlights one of the ironies of modern finance. Even the asset people buy to avoid financial system risk often ends up managed inside that same system. And there's another wrinkle: costs. Gold ETFs charge management fees. Self-directed accounts often involve custodial fees, storage costs, and insurance expenses. These aren't always huge, but over decades they can quietly erode returns. Which brings us back to the central tension around gold investing. Gold can protect wealth in uncertain environments. But over very long time horizons, equities still tend to outperform. That's because businesses grow. Technology evolves. Productivity increases. Economic expansion creates new value.
Gold doesn't compound. It preserves. Which is why many portfolio strategists treat gold not as a replacement for stocks, but as a small allocation, often somewhere between 5 and 10% of a diversified portfolio, enough to help stabilize volatility during crises, not so much that it drags down long-term growth. But even that guideline sparks debate. Some investors believe gold should play a much larger role, especially in an era of rising government debt and persistent inflation. Others argue that gold's historical returns are inconsistent, and that diversification can be achieved more efficiently through other assets. Both sides have data to support their case, which means the real conversation isn't about whether gold is good or bad. It's about what kind of world investors believe they're heading into, because markets reflect expectations, and expectations right now are unusually complicated. Inflation surged across the global economy in recent years. Central banks responded with aggressive interest rate hikes. Government debt levels remain historically high. Geopolitical tensions have increased in several regions. At the same time, technological innovation, particularly in artificial intelligence, continues to fuel optimism about long-term productivity growth. Two competing narratives are unfolding simultaneously. One says the future will be driven by innovation, economic expansion, and rising corporate profits.
The other warns that structural debt, monetary instability, and geopolitical conflict could create persistent volatility. Stocks represent the first story, gold represents the second, and investors, consciously or not, place their bets somewhere between those two visions, which may explain why gold has been quietly attracting renewed attention inside retirement portfolios, not necessarily as a speculative bet, but as insurance, a hedge against the possibility that the financial system may face shocks that traditional models underestimate. History offers plenty of reminders: currency crises, bank collapses, debt restructurings, moments when trust erodes quickly. And when that happens, assets that exist outside the financial architecture suddenly look very different. Gold has played that role for centuries. Empires rise and fall, currencies change, markets transform, and the same metal continues to trade, weigh the same, shine the same, almost absurdly unchanged. Of course, that permanence is both its strength and its weakness. Gold survives, but it rarely builds. It protects wealth more than it multiplies it, which means the decision to add gold to a retirement portfolio is really a decision about balance, growth versus protection, opportunity versus stability, confidence versus caution. And every investor, whether they realize it or not, is constantly adjusting that balance, sometimes through stocks, sometimes through bonds, and occasionally through a quiet allocation to something that has outlived every financial system humanity has ever created. But here's the lingering question. If gold performs best when trust in the financial system weakens, then what exactly does it mean when gold starts outperforming stocks? Is it simply a temporary market cycle? A short-term hedge against inflation or geopolitical tension? Or is the market quietly signaling something deeper about the stability of the systems our retirement savings depend on? Because if the asset designed for crisis keeps winning, the real story may not be about gold at all. It may be about what investors are beginning to fear: